Hi, good morning from our New York City studio. My name is Gad Lebanon and I'm leading the Labor Market Institute here at the Conference Board. Welcome to our November edition of Economics Watch. Today we have an exciting program and a special topic which is labor shortages. So we'll start as usual with our U.S. economic outlook, but then we'll talk about labor shortages. There is a new report from the Conference Board called Labor Shortages, Challenges and Solutions that will come out in a few weeks, and we are going to preview some of the results today. So we'll talk about things like why we're having tight labor markets, how are they impacting companies, why the impact is especially noticeable for blue-collar and manual services workers, but we'll focus on solutions to what companies are doing to deal with labor shortages. As usual, we have CPE credits, so you just need to type your full name and email address in the space provided. Click 3 OK pop-ups, and you have to stay online for the entire webcast, and this credit is available for live participation only. Together with me on this webcast, first we have in the DC area we have Elizabeth Crowfoot, a senior economist in the labor market group, and she is a co-author on the labor shortages report. Good morning, Elizabeth.
Thanks for having me, Gad.
And we have to my right Frank Stimmer, associate economist and also a co-author on this report. Good morning, Frank.
Good morning, Gad.
And Eric Lund, he's a senior economist at the Conference Board, and he's now responsible for our U.S. Outlook program. Welcome, Eric.
Great to be here.
So before we start telling you what we think about the U.S. outlook, we have a polling question where we want to ask you what you think about the U.S. outlook. So the question here is, what is your expectation for U.S. economic growth in 2020 versus 2019? There are three options: stronger, the same, weaker. So again, what is your expectation for U.S. economic growth in 2020? So let's give you 5 more seconds to contemplate your answer. 5, 4, 3, 2, 1. And let's close the survey. Okay, so there is more pessimism here than optimism. The majority of you said it stayed the same, but 30% of you said that it will be weaker, and only 10% said that it will be stronger. So, Frank, are you surprised by the results?
Well, we have been asking this question also in other economics watches already, and the distribution is more or less the same, and I think also in line with what we have been saying. Like, we expect that there is going to be a slowdown, especially compared to 2018. 2019, we have already seen the slowdown that started, but I think there are a few people that expect a stronger economy, and I think we're in line with that we expect it will be a gradual slowdown.
Eric?
I totally, this is in line definitely with our outlook for the year ahead. This year we're expecting growth at about 2.3%, down from 2.9% in 2018, and in 2020 we're expecting it to slow just a tad more to about 2%. In a lot of ways, when you look at some of the data that's been released, a lot of the slowdown has already sort of manifested itself. So I think, moving forward, we don't necessarily see a rapid decline. We just maybe see a shift in some of the compositions of what's sort of moving growth forward. And we'll talk about that a little bit more in the coming minutes.
Yeah. So let's get to that. So Eric, what are some of the main points of our outlook?
Sure. So as I mentioned, for next year we're expecting growth at about 2% versus a little bit stronger in 2019. And again, in the first quarter, we had GDP growth at about 3.1% this year, and we're already down in the third quarter to about 1.9%. So a lot of that slowdown has really sort of already been manifesting itself. There are, of course, downside risks to our outlook for 2020. There's, how the U.S.-China trade conflict sort of works itself out, how other economies function and perform next year as well, and so that has the potential to bring our projections down a little bit. But our base case scenario is that the U.S.-China trade conflict sort of stabilizes, and there's no real sort of floor dropping out from underneath the global economy. In terms of some of the individual aspects of the U.S. economy that we're thinking about, employment growth has been holding up better than expected. You guys are going to talk about that a lot later in the webcast. And I think for 2020, correct me if I'm mistaken, we're expecting continued tightness, but maybe just not as tight as what we've been seeing over the last year or two. As a function of that tightness, maybe mitigating to a certain extent, we're also expecting that the sort of tailwind that consumption has been providing to the U.S. economy is going to soften just a touch as well. So, in the fourth quarter, we still expect to see pretty robust holiday sales, but really I think moving into sort of the first half and then later into the second half of 2020, the contribution to growth that consumption is providing is going to start to sort of ebb. But there's going to be other aspects of the economy that are going to sort of make up for that. In terms of inflation, inflation remains relatively muted. The Fed has a 2% target rate, but we're hovering beneath that. So there's no real incentive for, I think, the Federal Reserve to try to tighten policy at all and reverse course to the loosening that they've been doing. Manufacturing is another thing that we are going to talk about a little bit. Manufacturing output has and continues to be weak. There was a slight uptick in the manufacturing PMI for this month, but it's still below 50. So we're hoping to see that improve a little bit over the next year, but it's so far it's been a drag. The Fed, I already mentioned, 3 rate cuts for this year. The guidance provided by Powell suggests that we're sort of coming to an end of that cycle. And then finally, one other thing that I think is worth mentioning is mortgages and residential investment. As a function of some of the changes in Fed policy, we've seen a decline in mortgage rates. And we've really seen a response from builders in terms of an increase in the number of starts and authorizations for residential construction. And that really manifested itself in the third quarter GDP numbers, where we saw really a rebound in residential investment after having been sort of in negative territory since 2017 or so. So that's sort of a broad overview of what we're thinking, and we'll go into a little bit more detail in the coming slides.
Yeah. Let's start maybe with the employment situation. So we are seeing some slowdown, but not as bad as some expected.
Sure. And I think when you really factor in some of the idiosyncrasies of the latest month's data in terms of the GM strike, in terms of some of the distortions caused by census workers, the markets really responded positively to these data. It was above consensus. And the labor market seems to be holding up fairly well. That having been said, and again, this is going to be something that you talk about, I think, a little bit more, that is probably going to ebb a little bit over the coming year or so. And of course, that's going to impact consumption as well. So in the slide that we're looking at now, we're taking a look at consumption expenditure really over the last 3 years or so. And there was really a bit of a weak point at the end of 2018. But really for most of this year, we've been seeing, on a month-to-month basis, these numbers continue to strengthen. Looking forward, less of a tailwind in the future as the labor market provides less support to consumption. And I think that we'll start to see this, this graph, this chart start to stabilize and possibly even trend down a little bit over the coming year.
Yeah, so I think you mentioned it, that consumption is probably going to slow down a little, because what we saw in the previous chart is that employment growth actually picked up a little bit over the last few months, which was remarkable. But we expect that going forward, with a very tight labor market already, with also economic growth going to slow down. So we do expect an employment slowdown going ahead. And as you were saying, this feeds into this consumption picture.
Sure, sure.
There is a question here about credit markets. Are we seeing standards tightening or credit getting squeezed? Well, let me start, and if you have anything to add to that, the senior loan officer survey from the Fed was released last week, and it did show that for credit cards, banks are tightening credit standards. So there, I guess, the fear of further slowdown or perhaps a recession in the long run is starting to impact credit standards. Any thoughts or things to add to that?
It's interesting, given sort of the guidance and direction of Fed policy in terms of trying to ease rates a little bit. You see this, some private sector actors sort of moving in the opposite direction, perhaps out of fears associated with risks down the line.
Yeah.
But again, our base case is that we do not expect to see a recession in 2020.
Yeah.
Moving forward, let's talk a little bit about inflation, because this, of course, really helps the Fed policy. The Fed think about how to construct policy, and it factors into their dual mandate. So, I mean, for the most part, U.S. inflation is and has been relatively manageable, if not under target. The Fed's inflation target is about 2%. And what we're showing in the chart here is both CPI, which is in red, and inflation associated with PCE. The PCE number is the number that the Fed looks at a little bit more closely in terms of helping to guide its decision on rates. And as you can see, we're still below that 1.5% number. So to the extent that the three interest rate cuts that have already occurred this year are able to sort of possibly push inflation a little bit higher, it's going to put the Fed in a position where it feels relatively comfortable in terms of what the inflation rate is. And we expect, I think, to a certain extent to see inflation possibly increase a little bit in 2020. Also, as I mentioned earlier, manufacturing is something that has been troubling the U.S. economy for a little over a year now or so. Really since 2018 or so, mid-2018, we've seen both the industrial production start to go down, and capacity utilization really follow through. For the last 1 to 2 quarters, we've actually been in contractionary territory. Earlier this year, there was actually hope. As you can see, there was a bit of an uptick in maybe the summertime. That manufacturing was recovering somewhat in the U.S., but it looks like we're stuck in that sort of negative reverse sort of gear for the time being.
Eric,
yeah.
So the manufacturing is obviously impacted by what's happening in the rest of the world. So what is, if you can briefly say, what's our outlook for the rest of the world in 2020?
Sure. No, that's a great point. Our outlook for 2020 globally is somewhat mixed. We expect in general global GDP to improve to a certain extent. We don't expect a global recession, and we don't expect to see major recessions in individual countries either. For the most part, the recovery in the global economy is going to be driven by emerging markets as opposed to advanced economies. So, while we do expect to see somewhat of a slowdown in the U.S. economy, we actually expect, for instance, China's economy, which has been performing very weakly over the last 1 to 2 years, to actually improve in 2020. So, of course, a lot of these countries and economies buy U.S. goods and services. So, to the extent that demand is augmented as a function of this uptick in growth, there is the potential that the U.S. manufacturing base will appreciate some additional demand, and that could increase the industrial production outlook moving forward.
Yeah. There's a question here. Do you have a more detailed report of growth by manufacturing sub-segments? Because pharma seems to be growing. I know, Eric, I think that in general there is always variation. Some areas are growing faster than others. I can, maybe you will continue, I can bring up some data on that and answer it in a minute or two.
Yeah. No, of course, the performance of any individual sort of sub-industry in manufacturing is going to highly vary upon the unique sort of circumstances and factors that influence it. But as Gad mentioned, he'll look into that a little bit more. Just to sort of buttress the industrial production data that I just showed, we also have here some numbers on PMI, the Purchasing Managers Index, for both the green manufacturing industries, and then the services sector is in black. Again, in negative territory, that's below 50. There was a bit of an improvement in the latest data point. But I also think one of the interesting things to see here is that the services sectors have not really followed suit to the in terms of contracting in the same way that manufacturing has. So the weakness that the manufacturing sector has been experiencing has been largely sort of compartmentalized and hasn't bled over. There has been a downtrend a little more recently in the services PMI, but again, it's still in sort of expansionary territory and is certainly performing a lot better than the manufacturing.
Yeah, it actually picked up in the last month again.
Yeah.
So indeed this downward trend.
Yeah.
But at least we can see that the services sector is not doing exactly the same as the manufacturing sector.
No, definitely. And all this sort of some of this gloom that the business community has sort of been experiencing. If you look at, for instance, our CEO confidence numbers, they've been relatively weak this year versus consumer confidence, which has actually been quite high. Mm-hmm. And one of the things that's driving CEO pessimism, I think, is the really deterioration of profit margins that we've been seeing in some of the data. And this, of course, influences their willingness to do things like make investments, which in turn hurts U.S. economic growth. So on the left-hand side, what we're seeing here is the non-residential sort of fixed investment coming out of the sort of the private sector from among businesses, and how that really strongly correlates with the profit numbers. So until those profit numbers pick up a little bit, again, external demand can help with that in terms of demand from overseas, or to a certain extent a resolution of the U.S.-China trade dispute, which makes input prices for a lot of these businesses more expensive, and therefore erodes profit margins as well. So both those sort of elements, there's upside sort of potential, I think, moving into next year.
Yeah, if going back to the question about the industrial production or manufacturing slowdown. So we definitely varies. I'm looking at some of the data. Like a lot of the weakness is in metals, machinery, also in printing and related. But also in the last months in the motor vehicles, partly because of the strike in GM. But there are also components that are growing, like the computer and electronic products are growing very rapidly. So it's a mixed bag. But overall, compared to other periods of time, it's a weak overall growth in manufacturing. We have another couple of more questions. How can U.S. consumer spending stay high if U.S. manufacturing stalls? Will wealth effect come from stocks investments?
Well, I mean, the manufacturing. Go ahead. I'm sorry.
No, go ahead.
No, I mean, the manufacturing sector is not, a huge part of the U.S. economy. And so the extent to which, maybe some weakness in that sector impacts things like jobs and wages and things like that, I think that there's a weak sort of coupling between those two.
Yeah. No, I think like in 30, 40 years ago, when manufacturing was a much larger share of the U.S. economy and U.S. employment, it would have been hard to decouple. But I think now employment in manufacturing is less than 10% of total employment, and the other determinants of consumption, like strong labor market and a relatively high housing and stock prices, are supporting consumption more than the weakness in manufacturing is hurting it. Yeah.
Okay. On Fed policy, it's been an interesting year. We've seen 3 25 basis point cuts in interest rates come out of the Fed, the most recent which occurred at the end of October. Guidance has been such that this has been dubbed sort of a mid-cycle correction. It's not supposed to be a longer-term sort of easing cycle. And the Fed, I think, has really been recently trying to manage expectations that unless we see a sort of a market deterioration in the economy or some really worsening of the U.S.-China trade dispute, and that really starts to impact the macro data that they look at, we're really not expecting to see additional rate cuts either or later in the 2.5 or 1.5 months that remain in 2019 or into 2020, early 2020 at least either. So in some ways, the cuts that have been made have really started to have an impact. For instance, if you look at the 30-year mortgage rates, we've really been seeing those drop in 2019. And of course, the lower these rates go, the more U.S. homeowners are either likely to refinance their home or possibly to buy a new home. And as I mentioned earlier in the webcast, we've been seeing that really show up in the numbers. If you look at housing starts and authorizations, for instance, a clear upward trend for most of 2019. And in the most recent GDP data as well, if you look at 3Q residential investment, that number picked up to about 4 to 5% after having been in contractionary territory since 2017. So the residential investment and building and kind of construction activities associated with it are another sort of buoy to economic growth that we're expecting to see in 2020.
If I can also make one more point on
Sure.
when we talk about the Fed, I think a couple of months ago there was I think a lot of fear in markets. We saw bond prices going up and down, especially the 10-year Treasury was very low now since the Fed has started to cut interest rates. Also, this yield curve inversion has now also disappeared. So I think we have also now moved, compared to the last couple of months, to an environment that is where it has slowed down a little bit. It's not as tense anymore as it was before.
Yeah, I get the sense that sort of the recessionary fears that really dominated the headlines maybe 4 or 5 months ago have started to abate a little bit. And the extent to which, the yield curve inversion sort of petering out factors into that, I think is a fair point, yeah.
Mm-hmm. So, Eric, what is our overall bottom line?
Yeah. So the bottom line is, again, slightly weaker growth in 2020 from 2019. That having been said, a lot of the slowdown has really sort of already occurred. 1.9% growth in the third quarter, maybe a slight uptick to 2% in the fourth quarter, but relatively stable, we think, after that. In terms of the driver for next year, consumption is probably going to play less of a role in pushing growth higher. It's going to possibly mitigate to a certain extent, but business sentiment, we think, is going to improve, which should result in a greater business investment, especially in things like structures and equipment. And then also this tailwind from residential investment should help to maintain growth as well.
Okay, thank you very much, Eric. It's a very clear and I think accurate outlook for the U.S. economy.
Well, our forecast of the third quarter growth came in on the nose, 1.9%. So it's a high bar to hit again, but I think we can do it.
Yeah. So now we're going to move to the next part of our webcast, which is the challenges of labor shortages. So let me start with a bit of so it's not the first time that we at the conference board talk about this topic. We actually started talking about it in 2014, and then people thought that we are a little crazy to talk about labor shortages. But we saw the unemployment rate going down very rapidly, and we asked ourselves what will happen if that continues for a few more years, and it did continue, and we reached a very low unemployment rate, 3.6%, the lowest in 50 years. And essentially in a span of 10 years, we moved from the weakest labor market since the Great Depression to one of the tightest labor markets. Now that I think is pretty well known. What is less well known is that we see the labor shortages much more visibly in the blue collar and manual service workers. Labor markets are much tighter than for the highly educated white collar workers, which is the exact opposite of the trend that we've been seeing in recent decades. So we're going to start with why is that happening, because this is it turns out that a perfect storm of several long-run trends converged at the same time to create this problem. And as a result, labor shortages are a real problem. A lot of employers often complain about the difficulty of recruiting, even when it's not difficult, but this time it is very difficult, and we are going to explain why. So the number one reason for why that is happening is the behavior of the black line that you see here. The black line is the annual growth rate in the working age population, here defined as 18 to 64. You see, if you go with the black line all the way to the left, you see it was at around 1.4%. That means that the 18 to 64 age group grew by 1.4% in 2001. In earlier decades, it was even reached 2% in some years. But it is dropping very rapidly, and now we are almost at zero. And the black line is likely to remain close to zero for the next decade, through 2030. And that simply as the large generation of baby boomer reaching retirement age, we are going to see more and more people leaving the working age population. Now, what you see here for the future, this is a forecast of the US Census. It's not our forecast, but we broke it down to several components. So, net immigration is positively impacting, then deaths in that age group is negatively impacting, but those are not expected by the census to make a big difference in the next several years. What is different is the blue line. So the blue line is, every year the 17-year-olds are entering the 18 to 64 age group, and every year the 64-year-olds are exiting this group. So how fast the black line is growing depends on how many 17-year-olds there are compared to 64-year-olds. In the year 2000, there were 2 million more 17-year-olds compared to 64-year-olds. Now the number is almost zero, and it's going to remain zero for the next decade. The baby boomer is such a large generation that it's apparently exactly as large as Generation Z, which is the generation that's coming in to the labor force nowadays. So very little can change this. Even if we have more babies now, it will take them 18 years to reach the labor force. So the only game changer here is if immigration becomes much larger, but that is, at least in the current political climate, unlikely to happen, but could happen in the future. An additional important trend that we're seeing is that not only the overall working age population is declining, more people within that group are getting a BA degree. So here we see the share in the labor force of 4 different education groups. So the main story here is that the people with a BA and above, their share is continuously growing, mostly for the simple reason that more and more young people are getting a BA. All the other 3 groups are declining. So that means that, and since people with a BA are quite reluctant usually to work in blue-collar and manual services jobs, that means that the number of people who are willing to work in those jobs is shrinking. And we're seeing this, that this is actually going to continue even in a more extreme way in the future. What we show here, we have 5 periods of 5 years. The last 2 periods are forecasts. And in each of them, the black bar is very similar to the black line that we saw 2 charts earlier. This is the growth rate in the overall working age population. So you see it is getting almost to 0 in the last period. But a very different picture emerges when we look at the education groups. The blue bars are the working age population of people with a BA or above. And that is continuing to grow almost uninterruptedly at around 10-11% every 5 years, so a little over 2% a year. So you don't see any change there. However, you do see a big change when you look at the red bars, which are the growth rates of the working age population without a BA. There we actually already see a shrinkage, and this shrinkage is going to become even bigger as we move towards the next decade. So fewer and fewer people in the population will have the education, will not have a BA, which means that the supply of workers to the blue-collar and manual services is likely to shrink. Now, in general, if you have fewer people, one way to get more workers is to have a higher labor force participation. But Frank, that has been quite a disappointment, right?
That has indeed been quite a disappointment. So when you were talking about working age population, that's barely growing. When we look at the non-BA population, it's already shrinking and going to shrink even faster in the coming decade. What could have provided some relief for employees is rising participation rates, because with the tighter labor market, you would expect that when employees have harder time finding workers have easier times finding a job. So you would expect that provides an incentive to join the labor market. And when we look at labor force participation rates over the last 4 or 5 years, we indeed see that these participation rates for men and women have both picked up a little bit. So just to understand what we're looking at the labor force participation rate for the prime age group. That is like the core group of the working age population, those 25 to 54 years old. So if we look at the blue line, we see that female participation is now back at 2007 levels, but still not as high as it was in the 2000s. And when you look at participation rates for men, the picture is actually even more disappointing. There's a small pickup over the last couple of years, but still very well below 2007, very well below 2000. And especially if you put that also in a more international context, if you look, for example, at other mature economies like Japan, European countries, there we have actually seen labor force participation rates gradually improving over the last 2 decades, where the US has actually started to fall behind. So you can see that with employment growth still growing, and with the labor market can just continue to tighten, because there's, from the working age population, we don't get that much support anymore to the supply of labor, and also from labor force participation rates, we don't see that many more people joining the labor force. Now, of course, this is just the national picture. If we now go again, like we did with the working age population, we look at only those, at the people without a BA, then it is even more disappointing. And that is what we can see in the next chart. So there are a couple of reasons why, especially the non-BA population, labor force participation rates has been especially disappointing. And the first reason has to do with the family structure, where there have been structural changes. So first, let me explain what we're looking at here. So here we're looking at the share of men aged 25 to 34 years old that are living at home with their parents. And as you can see, that since 2005, 2009, there's been a clear pickup, especially in the population that doesn't have a college degree. That now almost 25% of these young men are still living at home. So what explains this trend? So this has to do with young men that have had more difficulties forming and maintaining stable marriages. And as a result, they stay at home. And when you stay at home, you have less incentive to find work because you have a family to fall back on when you need to have food on the table, but also you don't have a family to provide for. So there's reduced incentive to go back into this labor force. And when we look at the next chart.
Just if I can ask a quick question on this. This is really fascinating. I mean, with the tightness that we're seeing in the labor market, with wages rising, especially among blue-collar employment, are we expecting to see this trend reverse? Are we expecting to see young men in this age group move out of the houses? At what point is the wage high enough to sort of incentivize them to actually
so this is what
spread their wings?
Yeah, so this is what surprises us also so much, that even though the labor market has tightened, these participation rates have actually not really picked up, or still much lower than they were in the 2000s, much lower than they were in the pre-recession periods, and especially for blue-collar workers, where labor markets are tighter, wages are rising faster. We don't see this reverse yet. But
that's fascinating.
Yeah, and I think it's more cultural than economic. I think, and you see, this is something that started already in the 70s, but really accelerated in the last 10, 12 years. It's not just economics that's driving it. If it was, then we're already seeing a reversal. But if anything, through 2018, this trend is just accelerating.
Mm-hmm. Right. So if we can go to the next chart, what we can see is how it has impacted these labor force participation rates. So now we look again at labor force participation rates, now for this group of young men, 25 to 34 years old, and you can clearly see how it has declined and not picked up for the population without the BA. Now this is one important supply trend. Another one has to do with the incidence of disability. So what we're looking at here is the share of people that are not in the labor force because of disability. We're only looking at those aged 25 to 64 years old. So when we start at the bottom of the chart, you see this blue line for the population with a BA or higher. And you see that the incidence of disability is very low there. So there's not really a reason not to participate in the labor market. But now if we move up, you see some college, you see high school, and especially those below or without a high school degree. There's a very large share that is not participating in the labor market because because of disability. So this is another reason why these labor force participation rates, especially in the population without the BA, have been so disappointing.
Mm-hmm. Yeah. So I feel like there is a gloom environment setting on the studio here, but it is those are disturbing trends, and so the impact of those is that there are fewer and fewer people who are willing to work in blue collar and manual services. Now, this would not have been a problem if the demand for those workers was declining as well, but this is actually not the case. So in recent years, we've seen blue collar and manual services jobs grow as rapidly as the rest of the economy. Partly it's because of the recovery in manufacturing employment. So we are seeing stronger manufacturing employment, this expansion, than any time since the 70s. A lot of it is because we see much less automation and offshoring of manufacturing jobs compared to earlier decades. We also see, because of the spread of e-commerce, we see a huge increase in the demand for drivers and warehouse workers. And we also see increase in the number of health support workers and personal care. So there are a lot of categories of jobs that hire almost entirely non-BA workers that are growing very rapidly and continue this demand for workers without a BA. So that's why we, after a decade of an expansion and those trends continuing, we see a very tight labor market. And probably for blue collar and manual services, we see the tightest labor markets on record. So in such an environment, one wonders what could be done to solve this. So one of the main topics of our report is the solutions to labor shortages. But before that, let's ask the audience a question here. So the question is your organization having difficulty recruiting or retaining workers? So the options are difficulty recruiting, difficulty retaining, difficulty both recruiting and retaining, not having difficulty either recruiting or retaining, and also do not know. That's also an option. So I know it's a lot to take in, so I'll give you a few more seconds. Recruiting or retention difficulties, it's just recruiting, just retaining, both, or none. So let's close it in 5, 4, 3, 2, 1. Okay, so we are closing it. So about 70% of you have some difficulties. Most of that 70%, 41% have difficulty both recruiting and retaining. About 30% of you have no difficulties recruiting or retaining, which my guess would be that you're either in companies that hire mostly white-collar workers, or you're in companies that have such a strong brand name that always people want to work there and stay there. But for the rest of us, we have recruiting and retaining problems. And we are going to talk about, from our research, what are some of the things that companies are doing. And Elizabeth, what are those things? Or maybe tell us a little more about the survey that we did to capture this information.
Sure, if we can move back to the slides.
Yeah, this one.
Great.
Okay.
So we did, the Conference Board conducted a labor shortages solution survey to dig in more to the reasons or what companies are doing to actually solve this labor shortage problem. And who did we actually reach out to? We had 225 business leaders that responded to our survey, mostly HR practitioners, and primarily at the director and above level in talent acquisition. Most of the respondents were from companies in the services sector and also large enterprises. One other question we ask companies is, what is the makeup of your workers? Are you mostly hiring white-collar workers, blue-collar workers, or about half and half? And nearly half of the companies stated that they were employers of mostly white-collar workers, which is important in terms of reflecting upon some of the results that we're going to talk about a little bit later. So, like I said, we did ask, what are these organizations doing to solve the labor shortage problem? And in order to do that, we gave our respondents a list of 59 possible solutions in order to choose from, and they selected those, and we're going to give you some results as to, what are the top solutions that most impacted companies have selected. And another goal was also to find out more about what are the adverse business outcomes, what has happened as a result of these labor shortages, what are companies seeing in terms of their day-to-day business. So we can talk a little bit about that as well. And this here is the response to our, we asked our respondents the same poll question that we just asked everybody here. Are our survey respondents having difficulty recruiting, retaining, or both? And we find that the majority, or at least the largest proportion, about 42%, are having both difficulty recruiting and retaining. About 28% of that dark slice of the pie was having difficulty only recruiting. A very small portion of this pie, only 6%, are having difficulty retaining. But when you add all these segments, a total of 70% of respondents said they were having difficulty recruiting, and nearly half, 48%, with difficulty retaining. And again, this is very much in line with what we just saw with our own webcast attendees, that with our survey, about 20% are having neither difficulty recruiting or retaining. And like Gad mentioned, it's mostly companies that have very strong employment brands where workers are still lining up at their door in order to find employment opportunities. So very much in line with what we were just seeing amongst our webcast attendees.
So what were the before we get to the solutions, what were the main impacts of the shortages on companies?
Yeah, this was a really interesting result as well. What we found, and what we're seeing here is the different solutions that companies did select. And the blue bars represent companies that hire mostly blue-collar workers, and the white bars are companies with mostly white-collar workers. And regardless of the employment makeup of each company, we see that the majority, or most of them, are operating with unfilled positions, and many of them are also increasing employee workload or overtime. And other than that, you see that for all the other impacts, the blue bars are much larger, much longer than the white bars. So it's really the blue-collar companies that are feeling the most impacts due to this labor shortage crisis. For even when it comes to retention issues, we're seeing increased employee attrition for blue-collar more than white-collar employers, lost institutional knowledge. When it comes to recruitment, they're seeing more decreased candidate conversion rates, candidates ghosting interviews. And what I thought was really interesting is it's really the blue-collar employers that are seeing the most adverse impact on their profitability. You can see that 37% of blue-collar employers that it's impacting their bottom line versus just 9% of white-collar companies. So, that really speaks to how this problem is impacting certain types of companies in distinct ways.
Yeah, it's certainly a big difference between blue collar and white collar. So in terms of turning into the solutions part, before Elizabeth will tell you more about the company level solutions, let's just think about solutions in general. So we divided it into two kind of levels. At the macro level, that if we have more immigration, then we'll have more workers and we'll have less worker shortages. So certainly raising immigration would be one solution. Now there are a lot of reasons why to have more or less immigration, and we're not getting into that now, but from a pure labor shortages perspective, more immigration would help solve the labor shortages solution. And then if we have higher labor force participation, that would be another potential solution. And there is a lot of things that the government can do in making work more attractive and removing some of the barriers from participation in the labor force, so that could be a solution. At the company level, we kind of divided it into three: recruitment solutions, retention solutions, and solutions that are related to more labor productivity or automations, solutions that would reduce the demand for labor. So in the report we talk a lot about those solutions, and here in the next 10 minutes Elizabeth is going to talk about the company level solutions.
Great, thank you, Gad. So let me go back one slide here. There we go, company level solutions. So in order to, again, really dig into what are the strategies that companies are using, we divided our sample into those respondents that were more impacted by labor shortages and those that were least impacted. And we define those as those that are more impacted are those companies that selected 5 or more of those adverse business outcomes that we were just talking about, and those that are least impacted selected less than 5. What we found is that it's the most impacted companies that are primarily composed of blue-collar workers. We talked about that, but they're also the ones that are most active in trying to solve the problem. So they're ticking off in our survey the 15 and 20 different types of strategies that they're using in combination in order to address this problem. The number one solution overall across all types of companies was raising wages and salaries, and I think that's a given. But what we found is that only helps to a point. There is a combination of other strategies, and they fall into these 5 other buckets. One is the tactical recruitment and retention solutions, reevaluating job criteria and relaxing hiring criteria, increasing training and developing talent pipelines, making the company a more attractive place to work, and expanding the target recruitment demographic. And I'll touch just briefly on each of these in the remaining time. So the first one is that we found that more impacted companies are really focusing on these tactical recruitment efforts and changing their recruitment processes. What you're seeing in this graph is the percentage of companies that selected each particular strategy. So in the left-hand side panel, you see the comparison between least and most impacted companies, and on the right-hand side, the comparison between white-collar and blue-collar companies. If we go back to the least most impacted comparison, what's also really important here is that gap between those 2 dots. So what we argue is that the difference in the usage intensity between the least and most impacted companies, those are the actual strategies that companies are using to combat labor shortages. Where we see that gap is smaller, those tend to be strategies that are implemented because of general business strategy or just general talent acquisition tactics, such as improving the company culture or improving employee engagement, even recruiting at job fairs and colleges. Those types of things are items that companies are doing anyway, regardless of the labor shortage environment. So we're not focusing on those strategies as much as the ones that have the larger gap. And in these graphs that we'll flip through the next few slides, the strategies are ranked in the order of the largest gap to the smallest gap. So what we find is overall the most used strategy for most impacted companies is adding or modifying an employee referral program. So we have examples of companies that can attribute 30, 40, and 50% of their recruitment to their referral program. So it's really an effective way to combat this issue. Other strategies in this vein include contracting with staffing firms to fill positions, implementing newer advanced technologies in the recruitment space, shorter recruitment process with fewer interviews, and increased social media efforts. And with social media, that was actually the number 2 solution that was used to target blue-collar workers specifically, behind increasing wages and salaries. So that was also an interesting outcome of our survey. We found that most impacted companies are much more likely to reevaluate job requirements and relax hiring criteria. This is about hiring managers really recalibrating their expectations about the type of talent that's available in the market today. So what they're doing is that they're reworking those job descriptions based on actual job skills or the actual skills and competencies needed to do the job. So you see here at the bottom of the graph, 41% of most impacted companies are reevaluating jobs to better assess credential requirements. And what this means is, companies are, for example, lowering requirements for experience and skills and competencies. Those are the two that were used more intensely. A fewer amount of companies are also accepting alternate credentials or lowering degree requirements. Those are also some items that we see companies are doing. The third bucket is lowering hiring requirements, creates a need for improving the skills of new recruits and investing more in training and developing talent pipelines. And what we hear from companies is that reducing or recalibrating their expectations, it's not about lowering standards, it's about just focusing on hiring trainable candidates with those those core competencies and being able to train them. What they say is that let's hire for 50% or 60% of what we need, and we'll hire the rest. So that's why you see that nearly half of companies are expanding online learning opportunities or expanding their internship programs, and other strategies include creating apprenticeship programs or developing integrated work programs with colleges and high schools and trade schools. And this last strategy is very popular amongst employers of blue-collar workers. You can see that it's really important for them to develop those relationships with vocational schools and in order to develop those pipelines into the trades.
Elizabeth, there is a question here. With companies lowering their hiring requirements, has any of them seen an impact to their revenue targets or ability to remain competitive? Well, we didn't ask them directly, those who answered that, if we didn't ask them these questions, but we did see there is a survey in the NFIB about where they ask companies, what is your number one business problem? And now the number one business problem is labor quality. And it's also the highest this answer, the highest percent this answer got ever. So it could be that there is no free lunch. If you lower requirements, you get workers that are not as productive or as good. Probably in a very indirect way, it does impact the ability to remain competitive. But keep in mind that your competitors are also probably hiring less qualified workers at the same time. So it's probably something that is impacting all companies. Elizabeth, we have 2 more minutes, so can you just finish one maybe additional slide?
Sure. I'll just mention this one is about making the workplace a better place to work. Mm-hmm. So companies are focusing on developing policies around flexibility. Really, the number one strategy here is increasing work schedule flexibility. It's something we mostly think about that white companies employing white-collar workers have implemented, but it's increasingly something that manufacturers and construction companies are also experimenting with because it's such a big pull in order to give workers the flexibility to choose their own work schedules and their shifts. That's the big one here, and also telework.
Yeah. Thank you, Elizabeth. We have a few more slides, but we don't have time to cover them today. But in the report that will come out in a couple of weeks, we have all of this and much, much more. So before we conclude, I just wanted to remind you that we're going to have Economics Watch again next month and every month after that. In our next month, it's going to be reflecting on 2019 and what's ahead, and it will be hosted by our own Eric Land.
It will be.
And very important, if you want to hear, there are 2 more webcasts on the topic of labor shortages. One next week, November 20th, we're going to release our occupational labor shortages risk index for about 500 occupations, which ones are at a higher risk. And on December 3rd, the impact of today's tight labor market on wages and pay compression. And we have a guest who is an expert on compensation to join us there. And finally, if you have any feedback or suggestions, please stay and fill our feedback form, and you can always email me if you have any comments. And if you want a briefing, by the way, if you want a briefing on the topic of labor shortages in our upcoming report, email me here, and we will be happy to provide it to your company. So thank you very much for joining me. Thank you, Elizabeth, Eric, and Frank for joining me here for a great webcast. And I hope you all have a great rest of the day. Bye-bye.